On occasion, the stock market gives us a case study rich environment that we can really dig into with lots of good Wyckoff lessons. And we started this discussion 2 weeks ago. Let's continue it in this episode, June 26th, right at the end of the quarter, really important time. Hi, I'm Bruce Fraser, your host, and this is Power Charting. So let's do market analysis the Wyckoff way, and notice this great cartoon on the right, which shows them banging the Wall Street drum and marching way ahead of the economy. Here's the national prosperity that is way behind the stock market. Hey, wait for us. So the stock market is doing the very same thing today, where the stock market is way ahead of the economy. Let's talk about that. Let's do some analysis and look at what's happened in the last 2 weeks. So we'll start with a couple of charts, dollar strength and gold. Then we're going to get into sentiment indicators. And then is the uptrend done? And conclude with point and figure charts. So this is a dollar index, UUP. Fascinating chart, goes back to 2007. You can see here a classic buying climax, and this buying climax is followed by a very sharp decline, which we're calling an automatic reaction. Sets a large range bound condition, very large for the dollar, which tends to not trade in a very wide range. So there is a secondary test, which is a big sign of weakness that goes under support. This is tested, and then a very sharp rally into what we're calling a sign of strength, the second sign of strength, and then a last point of support. Could this whole area be a giant Wyckoff-ian accumulation structure? Notice the volume dropping throughout, which is classic accumulation behavior. Well, here's a rally. These charts are so fascinating. So here is a demand line in green off of the test in the LPS. We draw a parallel on the intervening high, the sign of strength, and notice that right at this recent peak in March, the dollar touches this overbought condition and then returns very rapidly back down to the old resistance level defined by the 08 buying climax. And here we are right back on it again. And here are two, this is a broadening formation, very similar to what we've seen in the stock market, and up against these highs. Well, this is a very important place, because if this is a large accumulation, then this area should pretty much hold and then turn off of this and go into another rally phase. This may take some time to do, but we would be looking for that to happen. If it turns back into this large trading range, then this is a moment where the dollar could become weak back down to either this trend line or this support line. So this is a very critical place in the dollar. We know that the Fed is acting to massively increase money supply and credit in the system. Generally, we would consider that to be a negative for dollar strength. And so this will be a most important thing to study. Now, what are the implications for this? Well, first of all, if you look back here, this whole area is a period of strength in the stock market. So weak dollar, strong stocks. Then the dollar becomes very strong in 2014 into 2015, and the stock market stops going up and goes into an important consolidation into late 2016. So at a later date, we're going to line this up to the stock market and see whether we can draw any conclusions. But here's gold. And probably the most important thing I can say here is that I'll be the host on your Daily 5 on Monday and would love for you to be there. And we're going to talk about gold shares. So not, a little bit about gold, but a lot about gold stocks and silver stocks. But notice here that in 2018, a very important rally in gold happens off of this important support area. I wrote a blog August of 18 that you can go back and read as it was testing the support area, and then a beautiful rally up to where we're calling this resistance, very important resistance here, and looking for the possibility of maybe a consolidation, but then a resolution up and out of this very large reaccumulation area. Now, let's go back to gold, to the dollar and compare it to gold, because notice that while this very strong dollar rally is taking place, that normally we would expect gold to do poorly in such an environment. Well, this area right here is where the dollar became strong. Well, gold and the dollar are strong in this 2018 to the present situation, and that's very fascinating. So if the dollar goes back into the trading range structure and becomes weak again, that could be a double bonus for gold. So we're going to keep a very close eye on that. Next thing we're going to look at here is this is the S&P 500 futures short interest. And so the net shorts, and over a 9-year period, this is among, in 2020, the most negative short position in the S&P futures going all the way back to 2011. And so there are claims here that the bears are back because the short interest is so high. And I put these arrows in here, which shows roughly where the extreme short interest begins. And then you can see that the market tends to turn or rally off of that, but oftentimes reacts again. Well, here we can see very high short interest as the market's going up. Well, is this necessarily a sign that the bears are back? I would argue that the futures are a hedging tool for large institutions. And so institutions are cautious because, as we saw in that cartoon on the first slide, the stock market is way ahead of the economy, and there's very little visibility in the economy right now. So institutions are cautious. They know they have to go with the uptrend. They have to participate as stocks go higher, which they've gone up very, very quickly in the second quarter, which is about over. And they are doing some hedging as part of that. Not complete hedging, but there's some hedging activity I believe the institutions are doing. And that it may not necessarily be that the bears are back as much as it is caution among institutions to partially hedge with futures their long positions, and that is the result of their caution about the economy. That was also the case back in 2015 and 2016. You had Brexit and the uncertainties of Brexit, and also presidential election, so on, that institutions were careful. Notice that it was the higher low in the oversold condition of the futures net short, this area here and here, that was where the kickoff point of an important uptrend began. So we may expect that there will be some reduction of the shorts in the net shorts in the S&P 500 futures, and then maybe a higher low that would kick off a better rally. Now, we've looked at this chart numerous times, and this is the put call option ratio, which became historically oriented towards call buying, extreme optimism back in early June. And you can see here the green line, which is the 10-day average of this data, became very, very call buying oriented, very bullish speculation here, which is bearish for the market. This reading in January and February was a record at the time, which was exceeded in June, which shows that there's a lot of speculation in options. A lot of options trading is done among the public. Well, so now we're seeing this turning a little bit, but it's still, as you can see from the green line, extremely oriented towards lots of call buying, bullish speculation, and it's subsidizing. And here we're going to look at a climactic surge and a test that's occurred in June. And here is that climactic surge here we're looking at the Dow, then a very sharp decline. 2 Thursdays ago, I was recording power charting when this profound weakness started, which was a classic change of character in the market and suggests that we are in at least a range-bound condition. Resistance at the buying climax, support at the oversold point that came a couple days later, range-bound, and we're going to look at some point and figure charts of this in a minute. Okay, so here, same chart. I just wanted to show you the put in some very important support and resistance line. This is the 2018 buying climax, January of 2018. Look at this gap up through the resistance area. I said at the time that we were coming into the end of the quarter and that there was institutional pressure to put cash to work, and this was rushing funds into stocks into the end of the quarter. And that this is often, this behavior, which we call window dressing, is often punished. And in fact, here is the punishment, which is this very sharp decline. Well, look at the rally that's occurred. So here we have a trend channel. Dotted line is the overbought line. Went through it, failed. Now it's attempting to get back down to the bottom of the channel. And this is where support should come in on a couple of different bases. Here at the automatic reaction low and then also at the trend line. But here's the thing, look at the rally that came after. Very shallow, lackluster, did not get back up to the highs again. This is a point of vulnerability in the market. And now the market is turning back down and attempting to go back to support. We're going to be watching this very, very closely, because if there's a breakdown of this area, there could be a larger decline. Maybe goes down to this support area. We'll look at some point and figure here as we go. So it's so approaching the demand line, supply is present. You can see volume is high. There's some diminishing volume here, and we'll see whether or not this can become important support and produce another rally. So we'll be watching that closely. Here is the chart that I was just showing you, and this is the buying climax peak, so you can see how we got that resistance line. You can see the gap. This gap is the result of the end of the quarter, in my opinion, and also is the exhaustion of this very impressive rally from the March lows. So here we are. So can we get back down to the support line, which is also defined by action back in January, February of 2018? Could this whole area be distribution? That's a big subject for us. This could be a last point of supply right here. Well, let's talk about that in a minute. Here's the S&P trend line drawn off these 2 points. Look at how it's touched here, and it tried to rally through on a climax this trend line and then has returned back into this area. Notice the 39-week moving average. It's flirting with that. It got through it on a climax. It's come back to it. Well, I think it's important if the 39-week or the 200-day, the S&P gets back below it again. I think that could be an important clue that the S&P wants to react and retrace more of the gains it's made in the second quarter. So we'll see. Now, here is an interesting list of stocks. This is the source is Robinhood, and this data, which is compiled for different institutions, is the stocks that are being traded in large quantities by retail. So Robinhood represents a large retail presence, and you can see here that there's been something phenomenal in the second quarter, which is that retail traders, short-term traders, have really been phenomenally successful trading the market and have far outperformed institutions, which are all types of institutions, and the S&P 500 in the second quarter. And that, what is the reason for this phenomenon? Well, we'll talk about that a little more. But I will let you look at this list, but you'll notice that most of the stocks in this list are the most washed out names that have declined the most as the result of the economy being shut down. Walt Disney, Bank of America, the airline stocks, the auto stocks, oil and gas, cruise ship stocks. These companies have really been hammered in the economic decline. Well, also gaming. Well, there's a few in here that are have really been strong leadership. NVIDIA, Apple, Zynga. Let's see if we can find it. Netflix has been pretty good, and Amazon and Microsoft. So there are some important leadership names in here too, but I think they're in here just because they're extremely popular among the retail public. It's all the washed out names which have really rallied significantly in a bounce off of the lows. Well, why has this happened? And why are the institutions so interested in this trade flow and are willing to pay money to get this trade flow information? Well, there's a gentleman, Dave Portnoy, who is Barstool Sports. And when the sports industry got shut down during the COVID crisis, Mr. Portnoy had turned his attention to trading stocks. He'd never really traded stocks before the lockdown, and he had a huge following, 1.5 million followers that followed him in his media efforts on Barstool Sports, and he turned their attention to trading these washed out names in the stock market. Well, Mr. Portnoy had 1.5 million followers, and these followers all joined together with him, and he had a live video feed, and they would trade the market together because they were all in lockdown. And it's even said that they were using their stimulus checks to put into their trading accounts, and successfully. They had been trading very successfully. So I think that it's a fascinating event, and is my hat's off to these retail traders and Mr. Portnoy for having created this phenomenal trading juggernaut. And I think that this really speaks to the importance in the future of social media as an influence on stock trends, and that when you have people that are very important spheres of influence like Dave Portnoy, that they can really drive money flows in a very large way among their followers. And so this is going to be really interesting to watch going forward. And my only concern would be that these retail traders are good risk managers, put in stops, are careful, because you know, they're going up against very sophisticated institutional trader types and institutional investors. So here is something from Zero Hedge, or maybe, and I'll just read it, or maybe unprecedented is too strong a word. After the time retail outperformed hedge funds was in late February, just 2 days after the S&P hit an all-time high, when we posted the exact same observation, concluded by saying that while it is certainly a novelty to see retail investors outperform hedge funds, we doubt this divergence will last long. It did not, and the market crashed just days later. However, what has happened since is truly unprecedented, because if retail had merely smacked smart money returns at the end of February, it has positively crucified both the smart money and all the money in the face of the S&P 500 as of right now, when the basket of most popular retail stocks is up 20% year to date compared to the S&P, which after Thursday's rout ended down 5% for the year. So this was 2 weeks ago when that big reaction occurred, but notice that retail has gone to new highs. These retail investors in their retail favorite basket, which we just looked at some of the examples of that. And then here's the S&P 500 in blue, which has significantly underperformed this very strong retail presence, which has been piling into these very washed out names. So this is a very interesting phenomenon. I don't think we've heard the end of it. But what I would like to suggest is something I want you to think about as a Wyckoffian, is that the retail public tends to become most involved in the stock market over the top. So when you have the completion of distribution, the public is participating in a very large way, and they tend to get involved in the market when they see value show up for the first time in many, many years. So you can see this beautiful uptrend that's been occurring in the S&P going all the way back to 2016 and before, and we know that the bull market's been going since 2009. Well, here we have what appears to be a very large, wide, volatile trading range, which could be distribution at the conclusion of an economic cycle. And if the public is in this market in a big way on a failing last point of supply rally, then the institutions are going to be less involved and are becoming defensive because they see that the risks are high because the economy is now in a confirmed downtrend. So could this in fact be a big distributional top? In the presence of the public, the presence of retail being so persistently dominant and actually outperforming here, be an ominous sign for the completion of distribution. I'm just throwing that out there, and this is a very interesting place because we're up against these important trend lines and resistance lines in the S&P and the Dow and so on. And these are topics we're going to cover in the weeks ahead, weeks and months ahead. And also the other thing is the third quarter is going to be really tricky because it's the high point of the election season going into November, when there will be a presidential election. So it's going to be a crazy, crazy third quarter, I believe. And here we are in an exposed to overbought condition. Okay, so enough on that. I'm just going to say, if there's any Robinhood people that are listening to this, and I would just say, hey, great job, way to go in this rally. You did really good. Be a good risk manager, set your stops, trail your stops as your stocks go up, and be willing to go to cash. Don't get caught in a loss trap. So, and please come back and watch power charting again. So here is the Qs, and this was a chart. This was a point and figure chart that I did back in the March period. And as the market was rallying, this is through the beginning of May. And we had a count here that goes 240, 248. We hit a high of 251, and we have turned off of that. So fulfilled point and figure counts in the Qs. This count could potentially be larger. We'll keep an eye on that. Here is the Qs 2-hour chart, trend channel, beautiful trend channel. This is reverse use of trend lines. We draw the trend line here and here, and you can see overbought here, which is in early June, overbought again into late June. Now we're back into the channel. We'll watch really closely to see if the Qs have a change of character and become weak out of this trading range area. Okay, now here's another chart of the Qs. I'll just leave this for you. 251 is where we got to at the high. We published this chart in Wyckoff Market Discussions March 25th, and at the time said that this the Qs could go up to this level. And I think people thought we were crazy. The count line's at 168, and here we are, 251. Excuse me for losing my voice. And you know, we're 5 points away from the minimum count here on this area. Pretty darn good. And it's still possible the Qs could get there. So here's the SPY. I've shown you these before, but the S&P has gotten close to the 328 level, but has not quite gotten there. I've taken a very aggressive count here. Maybe should have taken the smaller count, but we're very close to fulfilling the minimum objective. In the Qs, we have done that, as we just talked about. And also these distribution counts worked quite well. So here is a very interesting chart in the couple minutes I have left of the Qs. And you can see here that this is a reverse use of trend lines. This is a much larger scale. This is 2018. The Qs continued to be leadership and have been on a rising scale since this climax in early 2018. These 2 points establish the reverse use of trend lines, overbought here, overbought again here. Here we are, June of 2020. We're overbought, and look at the large tail. We're back below this trend line, and we're, I think, in a situation where we may have to build a cause for another move. If there's profound weakness from here, then we're not going to get a reaccumulation count. We may have to go back down to, say, this mid-level trend line and possibly to the oversold line. So, which would be a very stiff decline. But we don't know a lot yet, so we're going to keep an eye on this what amounts to a very overbought situation on the Qs on a very large weekly chart. So this is a very profoundly overbought chart for the Qs long term. Okay, and now last thing, we only have 30 seconds left. I'll just show you these charts. Here's a count 2880 in the S&P. This is intraday 15 minutes. There's a larger count that goes lower, but let's focus on the smaller count first. And then here on the Dow Industrials, we have a count that goes 24.5 to 24.2, and that would be our working count. And then there's a larger count back to the highs that counts lower, but let's take it one step at a time. This could be an interesting place for weakness and then a rally back up and attempt to go back to the highs again. And with that, thank you for attending, and we'll see you next time.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.